If you didn't know, the Federal Reserve and major investment banks in the United States have reassured Americans of a soft economic landing and an end to the impending recession in the country. However, it's crucial not to blindly accept their proclamations. Instead of doing that, we want to examine specific indicators and compare them to available data, which show that the US and the world at large are actually teetering on the brink of an economic event that will have far-reaching consequences in 2024. So, in this video, we'll elucidate why we're on the cusp of one of the most severe economic downturns in the history of the United States. So, if you're ready, let's get right into it. For a start, total household debt in the US recently reached a staggering $17.1 trillion, with credit card debt crossing the $1 trillion threshold for the first time ever. These are more than critical figures demanding our attention because they show that the US is currently grappling with inflation through debt that is becoming increasingly unsustainable. Now, if we assess the current scenario regarding credit card debt versus the current scenario regarding personal savings, we'll find cold hard facts that restate the current economic problem, like we see in this graph. Now, as you can see, the green line represents the savings rate, while the red line signifies the leading contributor to household debt in the US, which is credit card debt. And as you'll see, the profound gap between these two lines is steadily widening on a monthly basis. Also, as the graph reveals, consumer credit is surging at unprecedented rates, and credit card interest rates recently surged to an all-time high of almost 35%. This means that, currently, people in the US are borrowing at record levels while saving at historically meager rates. It also means that there's a widespread wave of desperation for survival in the country, pushing people to run through their savings, and once that proves insufficient, they'll rely on credit cards, accumulating balances that linger month after month. Now, recent research already indicates that Americans will spend all of their accessible savings by the end of this fall, and it's difficult to argue with this projection because accessible savings have already dwindled at an average rate of $1 billion per month since January 2022. As such, the research suggests that if this pace of depletion persists based on historical rates from the past 3, 6 or 12 months, aggregate accessible savings are likely to be exhausted in the third quarter of 2023. So, you see, for all the marbles that America's economy poses to the world, the reality is that for its people, they're maxing out their credit cards while their income is being eroded by soaring prices. Basically, we're reaching a point where household debt is surging, along with delinquencies on that debt, and it's a trend expected to continue into 2024. For example, the resumption of student loan payments on $1.6 trillion of debt is just several weeks away, placing an additional burden on those with student loan debts. Delinquencies on auto loans, credit cards, and consumer loans have also recently reached their highest levels since 2012. And in the US's current environment, the combination of Federal Reserve rate hikes and escalating prices has created a perfect storm, contributing to rising delinquency rates. So with the labour market cooling down, which is inevitable due to these delinquencies, more and more people will likely face unemployment or significantly reduced income, meaning they'll struggle to meet their monthly obligations over and over, which, as you know, will contribute to more surges in delinquencies. Now, let's consider an interesting and vital fact. According to the Federal Reserve, the willingness of local banks to extend credit to consumers, which, in other words, would be their perception of the risk associated with lending at any given time, actually leads delinquency rates by approximately 9 months. So, in other words, on average, banks begin tightening their lending standards roughly 9 months before consumers start defaulting on their loans. To better understand this, let's look through this chart. Now, here the grey sections represent recession periods. The black line, on the other hand, represents delinquency rates, and the red line, which is inverted, represents banks' lending standards. Remember, the red line is inverted, which already indicates a negative correlation. But as the chart shows, an increase in consumer delinquencies actually aligns with banks tightening their lending standards, particularly during peak recession periods, which is precisely where the US seems to be heading right now. Also, as banks become increasingly hesitant to extend credit and consumers struggle to meet their financial obligations, we have to address the mounting debt-to-income ratio for prospective homebuyers, which, to be candid, has reached a point where owning a home in the United States is now a luxury. To put this into perspective, for the first time in history, the debt-to-income ratio for all homeowners has reached 40%. And during the 2008 financial crisis, when the country's economic situation was dire, the debt-to-income ratio peaked at 39%. But today, homeowners in the US find themselves at 40%, which is a problematic milestone to say the least. Now moving on, we've since talked through an exploration of credit card debt versus personal savings and also delved into the concerning trends of escalating delinquencies and the historic debt-to-income ratio. Now, let's look at insights from a recent JP Morgan report featuring predictions by their chief strategist Marko Kolonovic, who, in his forecast, emphasized the heightened probability of an economic crisis emerging in the US within the next 6 to 12 months. His opinion reads as follows. Following the regional banking crisis earlier this year, markets took an optimistic view. Soft lending became a consensus. European stocks rallied at the back of China reopening, and Japan stocks rallied as many institutions reduced exposure to China and moved money into Japan as a proxy. The US equity market rallied as investors extrapolated that AI will transform and boost the economy and corporate profitability in a short period of time. However, we see this as unrealistic. US tech stocks, particularly the largest ones, drove the market higher. This rally was mostly a multiple expansion on the AI narrative, while in some cases revenue of key tech stocks declined and overall corporate profits declined 6.5% year over year as of the end of the second quarter. Question now is, where do we stand? And should we analyze things differently, seeing that the market was more resilient than macro fundamentals warranted? As both premises for our cautious outlook, meaning rates and geopolitics, turned more negative over the past few months, and this is key here, turned more negative over the past few months, while positioning and valuations increased, we think there is now a higher likelihood of a crisis over the next 6 to 12 months, the severity of which could be higher than market participants anticipate. Risks of an interest rate shock and monetary tightening are clear. Consumer credit, real estate globally, funding of startups and businesses, increase of market volatility that comes with tighter monetary policy, and eventually the impact on employment. So, essentially, he's telling Americans to expect unemployment to rise with the coming economic crisis. And after seeing how several of the key economic indicators we've looked at in this video come into play, it's not difficult to agree with him and figure out that the soft landing that Americans have been promised, of course, is highly unlikely. In light of these findings, it's imperative that Americans reassess their expectations and strategies for navigating these challenging economic waters. Rather than relying on the hope of a gentle descent, they must prepare for the possibility of a more turbulent course ahead. This will entail devising proactive measures to address potential crises, safeguard financial stability, and ensure that their economic ship can weather the stormy seas that may lie ahead. Alright then, that's all for today's video. If you enjoyed it, please leave a like and subscribe to the channel. Also, share this video and press that post notification bell so you don't miss out on our future videos. We analyse the latest trending economic news, so watch out, and until next time, take care.